Stop. Before you scroll past this, I need you to hear this right now. What if I told you that in the last 30 years, over a dozen countries have watched their inflation rate blow past 100%? Not in textbooks, not in hypotheticals, in real life. Real grocery stores, real savings accounts, real people. People with jobs, mortgages, investments, watching everything they built get vaporized almost overnight. Now here's the part that should get your attention. In 2026, the economic conditions that made those disasters possible are closer to home than most people realize. I'm not here to scare you for clicks. I'm here to make sure you understand what 100% inflation actually means, what it does to your paycheck, your savings, your 401k, your mortgage, and what you need to do right now to protect yourself. Let's get into it. Okay, so let's start with the basics, because I think a lot of people hear the word inflation and their brain immediately goes to grocery prices going up $1 or $2. And yeah, that's inflation, but 100% inflation? That's a completely different animal. Here's the simplest way to think about it. If inflation is running at 100% annually, that means prices are doubling within a single year. Your morning coffee that cost you $3 in January, by December it costs $6. The rent that was $2,000 a month, now it's $4,000. The car that was $40,000, now $80,000. And here's where it gets brutal. Wages almost never keep up. So even if your boss gives you a raise, even a decent raise, the purchasing power of every dollar you earn is being cut in half. You're running on a treadmill that keeps speeding up, and most people don't even realize it until they're already falling off the back. Now, 100% is what economists call hyperinflation territory. The technical definition, the one that researchers and central banks actually use, comes from economist Philip Kagan, and he defined hyperinflation as inflation exceeding 50% per month. Per month. That's roughly 12,875% per year. So technically, 100% annually is what we'd call severe inflation, not full-blown hyperinflation. But I want you to understand something. Even that distinction is cold comfort when you're living through it. Because at 100%, you are already in crisis territory. You are already at the point where retirement savings get gutted, fixed income investments become worthless in real terms, and cash sitting in a savings account loses half its value in 12 months. Let me say that again because I want it to sink in. Every dollar you have in a low-interest savings account right now loses 50 cents of real purchasing power in a single year at 100% inflation. So why are we talking about this in 2026? Because the conversation around inflation has shifted dramatically. After the inflationary spike of 2021 to 2023, when we saw the highest U.S. inflation in 4 decades, peaking around 9.1% in June 2022, central banks globally went into aggressive rate hike mode. The Federal Reserve raised rates 11 times in a 2-year cycle. That cooled things down, but here's what most people aren't paying attention to. The structural forces that drove that inflation, they didn't disappear, they evolved. In 2026, we're navigating an environment where geopolitical fragmentation is fragmenting global supply chains. Energy costs are volatile again due to new Middle East tensions and the ongoing transition away from fossil fuels. Government debt levels in major economies are at historic highs, and we're watching emerging market currencies wobble in ways that haven't been seen since the early 2000s. Any one of those factors can spike inflation. All of them at once? That's how you get from manageable to dangerous very, very fast. And the scary truth? The average investor, the average working professional, has no real playbook for this. They've been trained by 20 years of low inflation and near zero interest rates. They've never had to think about what happens when the rules of the game change. Well, today we're going to give you that playbook. Let's keep moving. Let me take you back, because one of the most powerful things you can do as an investor, as someone who is serious about protecting their financial future, is to understand history. And history is very, very clear on what happens when inflation goes catastrophically wrong. The most famous example is Weimar Germany in the early 20s. After World War I, Germany was saddled with massive reparations debts under the Treaty of Versailles. The government's response was to print money, a lot of it. By 1923, Germany's inflation rate hit approximately 29,500% per month. By November 1923, $1 was worth 4.2 trillion German marks. People were burning currency for heat because it was cheaper than wood. Factories paid workers twice a day so they could spend their wages before they became worthless during their lunch break.
Now let's come forward in time. Zimbabwe. Between 2007 and 2009, Zimbabwe experienced one of the worst hyperinflationary episodes in modern history. At its peak in November 2008, the monthly inflation rate was estimated at 79.6 billion%. The government issued a $100 trillion banknote, and it wasn't enough to buy a loaf of bread. Zimbabwe's central bank ultimately abandoned its own currency entirely. People went back to barter and started transacting in US dollars and South African rand. And this wasn't some isolated ancient story. Venezuela. In 2018, Venezuela's annual inflation rate hit 1 million%. 1 million%. Oil-rich Venezuela, a country with the world's largest proven oil reserves, saw its citizens lining up for hours to buy flour. Doctors and engineers were leaving the profession to drive taxis in neighboring Colombia because it paid better. The middle class was essentially wiped out inside of 3 years. Now, I want to be crystal clear with you. I am not saying the United States or the UK or the Eurozone is about to hit 1 million% inflation. That is not the point. The point is this: the mechanisms that led to these disasters were not mysterious. They were not random. In every single case, the warning signs were there. Excessive money printing, unsustainable government debt, loss of central bank credibility, trade disruptions, political instability creating economic instability. Here's the uncomfortable question I want you to sit with. How many of those 5 warning signs can you identify in the current global economic environment in 2026? Because I counted and I came up with more than 2. And that is why this conversation matters. Not because catastrophe is certain, but because it's not impossible, and most people are completely unprepared. The people who survived Weimar Germany's inflation without losing everything, they weren't geniuses, they weren't lucky, they were informed. They moved their wealth into hard assets, real estate, gold, commodities, foreign currencies, before the worst hit. They had a plan when most people didn't even know a plan was necessary. In 2026, you have something those people didn't have. You have access to information, financial instruments, and investment vehicles they could never have imagined, so there is absolutely no excuse for being caught flat-footed. Let me show you exactly what 100% inflation does to every major asset class, and then we'll talk about what you can actually do about it. Let's go asset class by asset class, because I think a lot of people assume, okay, I've got a diversified portfolio, I'm fine. And the truth is, not all diversification is equal when inflation goes vertical. Some of what you think is protecting you is actually the most dangerous place to be. Starting with cash. If you've got a stack of savings sitting in a standard savings account earning 2 or 3% interest and inflation hits 100%, you are losing money at an absolutely devastating rate. In real terms, meaning what your money can actually buy, you are losing roughly 48% of your purchasing power in a single year. Think about that. You worked hard, you saved diligently, you did everything right, and inflation quietly picks your pocket of nearly half your savings in 12 months. Cash in a high inflation environment is not a safe haven, it is a liability. Next, bonds. US Treasury bonds, corporate bonds, municipal bonds. These are considered safe investments, and in a normal environment, they are. But here's the core problem with bonds in high inflation environments. Bonds pay a fixed interest rate. If you're holding a 10-year Treasury bond that's paying 4.5% interest and inflation is running at 100%, your real return is negative 95.5%. You are effectively paying the government to hold your money while it evaporates. The bond market, historically the safe retirement anchor for millions of Americans, becomes a slow-motion disaster during prolonged high inflation. Now, stocks. This one is more nuanced. Equities can actually provide some protection against inflation, but only certain kinds. Companies with pricing power, businesses that can raise their prices when their input costs go up, tend to hold value better. Think energy companies, commodity producers, healthcare giants with patent-protected products, and consumer staples brands. But growth stocks, tech companies that are valued on future earnings, those get crushed. Because when interest rates rise to combat inflation, which they always do, the discount rate on those future earnings goes up and the present value of the stock tanks. In the 2021 to 2023 inflationary cycle, we saw this play out exactly as expected. The S&P 500 had its worst year since 2008 in 2022, down around 19%. The Nasdaq, which is heavily weighted towards growth tech, fell nearly 33%. Meanwhile, energy stocks in the S&P 500 energy sector were up over 60% in the same year. Sector selection in an inflationary environment is everything. Real estate. Traditionally, real estate is one of the best inflation hedges available to regular investors. Here's why. When prices go up broadly, the value of physical assets like land and buildings tends to go up too. And if you have a fixed-rate mortgage, your monthly payment stays the same even as everything else inflates. You're effectively paying back your loan in dollars that are worth less and less over time. That's a massive advantage.
But, and this is critical, real estate only works as an inflation hedge if you own it. If you're renting, the landlord absorbs the benefit of that hedge, and your rent simply goes up with inflation. And in a 100% inflation scenario, housing affordability for non-owners collapses catastrophically. We saw an early version of this dynamic in 2022 and 2023, when the combination of post-COVID price spikes and rapid rate hikes created the most unaffordable housing market in decades. Gold and hard commodities. Gold has been humanity's inflation hedge for approximately 5,000 years, and there's a reason for that. It's scarce. It can't be printed. Governments can't just decide to create more of it. In every major inflationary period in modern history, gold has maintained or increased its purchasing power. During the 1970s inflationary crisis in the US, gold went from $35 an ounce to over $800, a 2,200% gain. In 2026, gold is trading above $3,000 per ounce, reflecting exactly the kind of inflation anxiety and geopolitical uncertainty we've been discussing. And then there's crypto. Bitcoin specifically has been positioned by its proponents as digital gold, a scarce asset immune to government-driven inflation. The argument has merit. There will only ever be 21 million Bitcoin, but the volatility cuts both ways. In inflationary panics, we've seen Bitcoin sell off along with equities because institutional investors hit by margin calls liquidate whatever they can. It can be part of a diversified strategy, but it is not a pure inflation hedge in the way gold is. Not yet. So, where does that leave you? Let's talk about exactly what to do with your money right now. Alright, this is the section I really want you to pay attention to, because information without action is just entertainment, and I'm not here to entertain you. I'm here to help you actually protect what you've built. Here's your framework. Think of it as 5 moves. Not all of them will apply to every person watching, but you need to understand all 5 and decide which ones make sense for your specific situation. Number 1, reduce your cash drag. The days of sitting on a large cash position in a standard savings account making 2 or 3% and calling it safe, those days are over in a high inflation world. If you have more cash than you need for 3 to 6 months of living expenses as an emergency fund, which you absolutely should maintain, the excess needs to be working harder. In 2026, that means at minimum moving excess cash into high-yield savings accounts, money market funds, or short-duration treasury bills, which have been yielding meaningfully above traditional savings rates. At least your money is fighting back against inflation to some degree. Number 2, build your inflation-resistant core. This means a deliberate allocation to real assets. I'm talking physical real estate if you're in a position to own it, or REITs, real estate investment trusts if you're not. It means a meaningful allocation to commodities through ETFs or commodity-linked stocks. It means gold, not necessarily physical bars under your mattress, but gold ETFs like GLD or AIU, or gold mining stocks for a higher beta play. These are not sexy investments. They don't go viral on financial Twitter, but they are the boring, effective backbone of wealth preservation in inflationary environments. And before anyone clips that graphic and says I told you to put exactly this much in each thing, I did not. That's an illustration. Your allocation depends on your age, your risk tolerance, your existing holdings, your income stability. Please talk to a qualified financial advisor about your specific situation. What I'm giving you today is a framework, not a prescription. Number 3, audit your fixed income exposure. If you're in your 30s or 40s and you've got a significant chunk of your retirement account sitting in long-duration bond funds, you need to have a serious conversation with yourself and your advisor about that positioning in an environment where inflation could remain elevated. I'm not saying get out of bonds entirely. I'm saying consider shortening duration, moving from 20 and 30-year bonds toward 1 to 5-year bonds, and consider TIPS, Treasury Inflation Protected Securities. These are U.S. government bonds whose principal value adjusts with the Consumer Price Index. They're not perfect, but they're specifically designed to protect against inflation eroding your bond returns. In 2026, with the CPI still running above the Fed's 2% target, TIPS deserves serious consideration in any retirement-oriented portfolio.
Number 4, and this one people almost never talk about, invest in yourself and your income-generating ability. Look, in a high inflation environment, your earning capacity is your most powerful inflation hedge of all. If you can increase your income faster than prices rise, whether through a promotion, a career pivot into a higher demand field, launching a side income stream, or developing skills that command higher compensation, you are fighting inflation at the source. The people who historically did best during inflationary periods weren't just the people with the right investments. They were the people whose incomes kept pace or exceeded inflation. Think about that for your own situation. What is the move that increases your earning power in the next 12 to 24 months? Number 5, diversify globally and across currencies. The US dollar is the world's reserve currency, which gives it enormous built-in protection against inflation compared to most currencies. But in a scenario where US inflation hits genuinely severe levels, dollar-denominated assets alone are not enough. Consider international equities, particularly in countries with lower debt-to-GDP ratios and more conservative monetary policy. Consider assets denominated in Swiss francs, Singapore dollars, or other historically stable currencies. Global diversification is not just about chasing returns. In an inflationary scenario, it's about not having all your eggs in one currency basket. Now, let me be real with you for a second. Even if you do all of this, even if you nail every single one of these 5 moves, there is no investment strategy that makes 100% inflation painless. There isn't one. In a genuinely severe inflationary environment, everyone's standard of living takes a hit. What smart financial positioning does is reduce how much of a hit you take compared to people who aren't prepared. It is about damage mitigation and relative preservation of purchasing power. That's the honest truth, and you deserve the honest truth. The good news, most people watching this right now are not taking any of these steps, which means by simply being informed and taking action, you are already ahead of the majority. Let's bring this home. Here's where we are. In 2026, inflation is not a relic of the 1970s or a crisis that only happens in poorly governed emerging economies. It is a live risk in the global financial system. The structural triggers are present: elevated debt, supply chain fragility, geopolitical instability, and a global transition in energy markets that will create price volatility for years to come. 100% annual inflation would mean your money loses half its purchasing power in a year. It would mean the fixed income retirement savings that millions of people have built over decades get silently gutted. It would mean that cash is not king, cash is the victim. And it would mean that the people who understood what was happening and positioned themselves accordingly would come out the other side in a fundamentally different place than the people who stuck their head in the sand and hoped for the best. So here's what I want you to do in the next 24 hours. Not next week, not after the next Fed meeting, tomorrow. Review where your cash is sitting and whether it's earning anything meaningful. Look at your investment allocation and ask honestly, how much of this holds its value if prices double? Have a real conversation with a financial advisor or do your own research on tips, commodities ETFs, and real asset exposure. Think about what you can do to strengthen your income and consider how global your current investment exposure actually is. None of this is complicated, but most people won't do it. They'll watch this video, nod along, and go back to their day. And if inflation does accelerate further, those are the people who will be scrambling to figure out what happened to their savings, while others who took action will be in a far better position. You are not most people. You're here, watching this, trying to understand the world and protect your financial future. That already puts you ahead. So now, go do something with what you've learned. If this video helped you understand something you didn't understand before, I want to know about it. Drop a comment below. Tell me what surprised you the most, or tell me what question you still have, because I read those comments and your questions drive the next video. If you haven't subscribed yet, I genuinely don't know what you're waiting for. We break down the most important economic and financial stories affecting everyday investors and working professionals, and we do it in a language that doesn't require a finance degree to follow. Hit that subscribe button, turn on the notification bell, and share this with one person in your life who needs to hear this right now, because trust me, you know somebody who does. I'm going to be back very soon with a deep dive on what the Federal Reserve's next moves actually mean for your mortgage, your car loan, and your savings rate in the second half of 2026. You do not want to miss that one. I'll see you there. And take care of your money.
I'll be back soon.